If you are a trader or just interested in the financial markets, most likely you've heard of the VIX index. In this video, I will explain what the index is and how to use it to trade its derivatives or to use it as a filter for other strategies on other instruments. So the VIX index is a forward-looking indicator, meaning it can forecast the price of the SP 500 index because the VIX index is built on the SP 500 index option prices. It basically looks 30 days ahead on the price of options and determine if there is risk, uncertainty in the market or there is not. So when there is risk or uncertainty in the market, the price will go up, the price of the S&P 500 will go down. And when the price of the index is low, that means there is no risk or there is certainty in the market. And that means the price of the S&P 500 most likely will go up over the next 30 days. Now, the index itself, it's not tradable, but there are derivatives on the index like VIX, which is the futures, or multiple ETFs that you can trade on the index. So here I have the index at the bottom and the futures derivative on the top. So you cannot trade the index like I mentioned, but you can trade the futures or the ETFs. And if I zoom out, we can notice something immediate, which is the VIX is always in a down drift. So this data going back all the way to 2006, and we can see whenever we spike, we go down. Whenever we spike, we go down. So if we look at the previous spike, so this is around 85, and that's the 2008. And here we have two at 45, this is 2011 and 2010. And then we have two more at 45. This is 2015 and 2018. And then we have the most recent, which is COVID at 85. So if we are looking for spikes to trade the index, we're going to have very few signals. Basically, we have two at 85 and four at 45. And maybe another 6 or 10 at around 20 something. The problem is, how do you know if the 10 or 20 spikes will go to 40 or will go to 80? Because if you short 20 and the spike goes to 80, basically you will be wiped out. So the way to trade the index is not to trade the spike up. Instead is to wait for a spike up. And when it goes down, then we short that market. Because basically we're only looking for short trades. There is no point in going long on the VIX. It's drifting down all the time. Now, there are many ways to do this, and I am going to use a simple moving average crossover. So I have a fast moving average, a slow moving average, and when they cross, when the fast moving average cross below the slow moving average, I will short the index, which is basically I'm shorting the futures. And when the cross happen on the opposite side, I exit the trade. So very simple. But that is a signal to enter a strategy. But we will also use it as a filter for other signals. So let's do the strategy on its own first. Okay, so now I applied the strategy of the two moving averages. And you can see here the light blue is the fast moving average. The dark blue is the slow moving average. So whenever we cross above, we exit the trade. When we cross below, we enter the trade. And so on and so forth. So the strategy is immediately profitable. Now, this is very important because you need to learn this. I mentioned this in most of my videos, which is priority number one is matching the style of the strategy to the characteristics of the instrument you want to trade. In this case, we want to trade short only, and we are waiting for a spike to go down. So we need to match a strategy style for that instrument. And that's why it's very easy to find a profitable strategy. And we're making 3-to-1 return to drawdown ratio. And if we look at the trade analysis, 163 trades, 460 on average, and 52 win percent. But let's optimize now the entry and exit. Now, currently I am using the entry and exit the same. So you can see here the strategy has 3 parameters. So the fast length for entry, slow length for entry, and fast length for exit. Now, in order to reduce the number of parameters, I made the slow length of the exit 3 times the fast length. So it's fixed. And that's how you can reduce the number of parameters to trade. Also, of course, you'll reduce the number of optimizations, which is a very good habit to get into. In any case, currently for this strategy, I was using the same. So 5 and 20. So 5 for the fast moving average and 20 for the slow moving average. And for the exit, I am using 5 as the fast moving average. And it's a fixed ratio. Remember, it's 3. So that means 15. It's the exit moving average. So now we will optimize all of them from 5 to 60, step 5. That should gives us about 1,700 strategies. So remember, I'm trading the VIX futures. So this is just for illustration, the index at the bottom. So here are the results. And if we sort by return to drawdown ratio, and let me go down. So let me look at 3. Okay, so this is 3. So 660 strategies above 3 to 1 return to drawdown ratio. That's really, really good. Like that's almost a third of the strategy. So let's filter for 50 trades because we're not going to have too many trades. And let's see, we have 403.8. And let's look at the graph. Okay, so this is about $80,000. So right now what we have is the fast length and the slow length. The z-axis is net profit. And then this filter is the exit. Remember, the exit fast length and then the exit slow length moving average is 3 times the fast length. So that's why I did it, because now I can only look at these and I can easily judge a stability pattern. So let's move down. Okay, this all already looks good. So 15, the exit, and I can see here there's a huge stable area. 20, even better, almost half of it. And 25. So 15 to 30 looks very good. 35 is going down. And 45, very good stable area. 50 again back. So almost all of them stable except for 5 and 10. So 15 and above, they're all stable area. So I have no issues. Now with 15, we have only this section. So this is the fast length. So up to 20. But then if I go above, look at this. From 45 all the way to 5 on the fast side. And actually all the slow side is good. And you can see this is a this nice pattern. This is when there is no crossover. So it's 0. So this is not a dip. Like this considered stable because it's just there is no crossover because the moving averages are the same value. So let's look at something around 20. So if I go here and look at 20, okay, so these are all 20, they are all good. And I'm going to look for something, maybe this one. This is 6, return to drawdown. Remember, they're all stable. So let me pick this one. And let's look at the stats. So this is 50 trades, 56% win rate, about $3,000 per trade. That's huge. And if I look at the curve is very, very nice. The only drawback is the number of trades. Okay, so trading the VIX itself is very profitable. In fact, we have so many options to trade because there's a huge edge in the VIX, which is it's always drifting down. Remember from my old videos, I mentioned that the ES always moving up. This is even better. It's always moving down more than the S&P 500. Now, you already can tell that because of this drift, so most likely it's highly correlated, negatively correlated with the S&P 500. And if you reach that conclusion, you are correct. The VIX index is negatively correlated to the S&P 500. Of course, it's built on the options from the S&P 500 index. So they are huge, like the relation is very big. So that means we can trade the S&P 500 based on the VIX signal. So here now I have the ES at the top. This is the futures and this is the VIX index. And again, I'm using the same moving average, fast and slow. But this time when they cross, I am trading the ES instead of the VIX. And I need to do this on the opposite side, because remember, the ES is negatively correlated to the VIX. And in fact, we can see this very clearly. If I zoom out, you can see whenever the VIX peaks, the S&P 500 bottoms. And whenever the VIX bottoms, the S&P 500 peaks. So it's clearly the opposite signal. So now I can optimize again. Now I'm optimizing this moving average on the VIX index, but I am trading the S&P 500. So these moving averages are on data 2. And again, the slow moving average of the exit is 3 times the fast moving average of the exit. Because remember, these two moving averages are for the entry and this moving average is for the exit. So again, we're optimizing from 5 to 60, step 5, about 1700 strategy. So out of 1700 strategies, I filtered 100 trades and $100 moving average. I have 34 strategies that are doing really well. And if I sort return to drawdown, I have 4.8. And if we look at the 3D graph, so this is 5, the exit, and then 10, 15. So 20 is already good. I have this diagonal. And then 25 is also good. This is a huge stable area. 30 is good. 35, not so much. 40 starts to drop. 45 is really good in here. So again, whatever you pick, there is a big, huge stable area. Look at the 55. Almost all of it is a stable area. And so let me pick maybe this guy. 80 trades, 64% win rate at $1,100 on average. This is for the ES. So this is a huge average trade. And this is the equity curve. So here are 5 strategies. So as you can see, I'm trading the ES futures and using data 2 as the VIX index. And I'm using the signal from the VIX index, the moving average crossover, to enter and exit the ES. But because there are low number of trades, so I picked 5 strategies. Now I can trade the micro futures and I will need half the margin required for one mini ES contract. So that's also an advantage. Now I need less money and I'm trading better strategies. Of course, they will have correlations, but it still is better than picking one. So let's backtest these 5 strategies and look at this. This is amazing. So how many trades now we have? So I have now 283 strategies. On average, I am making $2,400. So that is an advanced way to trade, because most people looking for a single strategy, the holy grail, I'm gonna trade this strategy, be rich. But usually it doesn't work that way. You need more than one strategy. You can add 5 more strategies, and now you're trading 10 strategies with the margin requirement of a single E-mini. Here is the periodical analysis, and we can see since 2007, and currently I have 4 trades this year. I'm doing this video till the beginning of March 2024, and we have 4 trades with 100% win rate, and the average is about $3,500. But here is the part where I want you to focus on. So we are trading the same instrument, the same strategy. I'm only picking different lookbacks from a stable area. So this is not over optimizing. I'm picking a stable area. And yes, I have correlations, but still, this is not 100% correlated. So I'm still getting diversification from this portfolio. Like, look at this. This is 0.35, 0.43, 0.46. So this is really, really good. And finally, because the VIX index is negatively correlated to the S&P 500, we can use it as a filter for other strategies on the S&P 500. So let's try that. Now we added the RSI2 strategy on the S&P 500. So this is the regular RSI2 strategy. When the RSI2 below 25, we go long. And when the RSI2 above 75, we exit. So this is the strategy. $175,000 profit, 3.8 return to drawdown ratio, and 327 trades, 76% win rate, $500 on average per trade. So now I will use the VIX as a filter to enter the RSI2 strategy. And in this case, we will use when the moving average, the fast moving average above the slow moving average, we will allow the strategy to go long using the RSI2. And when the fast moving average below the slow moving average, we will not allow the trades to happen. So very easy, it's just a filter. So now, because we are using the VIX as a filter, we don't have an exit moving average. Remember, we are using the RSI to enter and exit the strategy. So this is just a filter. So we'll go from 5 to 100, step 5. And here I have, let's go with 4. So I have 89 strategies that beat the original strategy. And this is 7, obviously, this is really good. And if we pick this one is using 40 and 65. So 40, the fast length, 65 is the slow length. And let me pick that one and let's look at our stats. So now we filtered almost 150 trades. We increased our average trade. We increased our win rate. So everything is good. The curve, oh my God. This is one of the best curves for the RSI that I've seen in a while, because like there is almost no dip. And let's look at the periodical, and yeah, as expected, it's one of the best curves so far. So 2007 is a loss, that's nothing, and then it's a win all the way. And again, look at this year, 100% win rate for 3 trades and making $3,000 on average. I mean, come on, if you are watching this channel and you didn't pick any RSI strategy yet, I don't know what to say. Because so like I featured probably 100 tradable, robust RSI strategy so far on the channel. The takeaways are the VIX index can be traded on its own and it's really profitable, can be used as a signal to enter and exit a strategy on the S&P 500, and also can be used as a filter, and it's really potent filter on the S&P 500. Because remember, all other filters are a derivative of price. Now, last video I did was about using volume, which is totally different. And now this is the VIX, which is also totally different. To learn more about the VIX, watch this video and I will see you there.